All right, what's going on, guys? I have been traveling this past week for business, and I just got back, and I thought one of the first things I would do is make a video for you guys. I was reading when I was away, and specifically, I found this article that was talking about fintech being kind of the next, or I should say, open finance being the next fintech revolution. Open finance includes things like DeFi or decentralized finance. So it's more of a broader term that incorporates DeFi and all of the other decentralized solutions that are being created. But I'll go ahead and just jump into the article. Open finance, open source financial services infrastructure built on public blockchains may be the next major digitization narrative after fintech, driven by the transformation of analog liquidity, deposits in bank accounts, to digital liquidity, tokens and digital wallets. The playing field can be leveled for offering financial services. As a result, new profit motives are introduced, encouraging innovations not previously feasible. Now, this article does go into DeFi, which I have another video about, which I will link when it pops up. But there are two other sections I will be jumping into. Technology disrupting finance is a narrative that's existed for a long time. The dream has always been for tech to digitize financial services, increase competition and access, reduce concentration risks, and improve customer experience. Many sales pitches have tried to achieve this, from fintechs, tech fins, API, open banking, to permission blockchains. You can see here they have a graphic that shows the fintech revolution that began right after the financial crash or the recession, with things like Square, Stripe, Lending Club, SoFi, Robinhood, Betterment, Wealthfront. Then we have TechFin, which is more the integration of financial services into social network platforms and ecosystems, leveraging consumer data to offer or distribute financial services products. Baidu, Alibaba, etc. Open banking. This is mainly around when the banks were a little bit more open to opening up APIs that allowed integration between your bank account and services like Intuit, Xero, Finicity. There's other ones as well. I had an app on my phone that helped me with finance, that tapped straight into my credit card companies, my bank account, stuff like that. And then you have permission blockchains, obviously, that we're in this area now, which has moved past this. But 2017 was definitely the rise of permission blockchains. Consortia led efforts to re-platform existing FS plumbing onto distributed ledger technology and use smart contracts, digital asset holdings, R3, Corda, Hyperledger. So this gives you a little overview of how we've progressed. While this decade-long lineage of innovation was transformative, it has not been disruptive. The playbook lacks imagination. Copy and paste a financial system that's been designed for the analog world and then overlay digital interfaces to make it more accessible. As a result, it's 2019, and while there has been progress, nothing really has fundamentally changed. Our attempts at consumer-centric banking remain clunky. The unbanked are still unbanked, and we still have a system that is highly concentrated and not modular. This article proposes that the more interesting innovation of the past decade has actually been developing right under our noses, hidden in plain sight. Public blockchains like the Bitcoin and Ethereum networks have been progressively installed to challenge past narratives, starting with the availability of new open source, public, self-governing, and globally accessible financial settlement infrastructure, aka open finance. For this reason, it shouldn't be surprising that the previous digitization narratives have resulted in incremental but not disruptive changes. Once market participants expand their tunnel vision focus beyond the price of digital value issued on these blockchains, i.e. tokens, it becomes possible to imagine a new financial services economy based on new constraints. The focus of this article is to begin exploring very early innovations emerging that are only now possible, painting a picture for why open finance may eventually be the new fintech. So like I said, section 2, I have a video that covers it. section 1 we'll be talking about, and we'll go over section 3. It is quite long, so I don't want to bore you guys. Evolution of banking and liquidity in open finance. In the traditional financial system, banks are granted a special role in the transmission mechanism of money, aka liquidity, through the economy. How does the money transmission mechanism work today? And you can see here, central bank, commercial banks, investment banks, and how the money here on the right is used. Loans and credit creation for the banks, stocks and bonds for investment banks, and central banks create the sovereign money. Central banks moderate a nation or set of nations' money supply to achieve inflation and sometimes employment objectives. To do so, they use tools like setting interest rates, conducting open market operations, and prescribing bank capital and liquidity regulations. Commercial banks operate under the central bank to pool their country's money by competing to aggregate deposits of its citizens. They then lend these aggregate deposits on a fractional reserve basis to create loans, which is credit, in a process known as maturity transformation. This exposes banks to a structural risk of borrowing short-term and lending long-term. To compensate for risks from the structural asset-liability mismatch, commercial banks are given two special privileges no one else gets. One, direct access to the central bank created liquidity in an emergency, and two, deposit insurance. And we saw this number one during the financial crisis of 2008, 2009. This is basically the bailouts that we saw. Investment banks, not technically a bank, issue various types of assets, example, IPOs, corporate bonds, etc. In doing so, they channel people's bank savings into these assets. Some investment banks additionally perform bank-like activities like securities lending and borrowing, also known as rehypothecation. This practice often creates the same structural risk that commercial banks face. Example, borrowing short, lending long. After the 2008 crisis, most investment banks on the brink of failing due to liquidity crisis were forced to recharter as commercial banks so that they too could get commercial banking special privileges, meaning that they could get bailed out. How does the banking transmission mechanism change in open finance ecosystems? In a world where money transmission is not controlled by a network of banks, value can be transmitted in new ways not as constrained by physical borders. With open finance infrastructure, it is possible to design a system where money aggregates and flows in different ways. So if you remember the last chart we saw is here. So here we have public blockchains and miners that then funnel to fiat crypto exchanges, which then funnel to open finance infrastructure. Obviously, we know about the DeFi, decentralized finance stuff going on Ethereum. There's similar stuff being built on Bitcoin, which I plan on doing future videos on. Here on the right, non-sovereign money creation. It's at the top. Here in the middle, fiat and commercial banks, fiat crypto exchanges and commercial banks. Digitization of value, fiat conversion to digital currency, example, Bitcoin, Ethereum, stablecoins, and natively digital financial services built atop the public blockchain infrastructure, Bitcoin Lightning Network, and then we have DeFi for Ethereum. Fiat crypto exchanges become the on-ramps that transform analog liquidity, example, fiat money sitting in a bank account, into digital liquidity, example, tokens sitting in a digital wallet. New entrants like Coinbase or individuals themselves become the de facto banks in these new ecosystems. On the more conservative end, fiat can be converted into fiat-backed stablecoins, example being USD coin, True USD, etc. In more novel approaches, fiat can be converted into digital non-sovereign cryptocurrencies, example, Bitcoin, Ethereum, make or die stablecoin, these are truly decentralized currencies. Open source infrastructure built on top of public blockchains facilitate the movement of this digital liquidity across electronic borders. Different public blockchain ecosystems will have their own set of financial services, applications, and protocols depending on their governance, beliefs, and ideologies. For example, Bitcoin's ecosystem is generally more conservative and is focused on building layers of applications, while in Ethereum's ecosystem, there is a prioritized focus on building applications using its Turing-complete smart contract coding language, Solidity. This flexibility has both its upsides and drawbacks, a topic for another article. This is specifically talking about speed. With Ethereum, obviously, it's all in one layer, but that comes at a cost of speed, transactions per second on Ethereum. And with Bitcoin using its more layered approach with the Lightning Network as a layer 2 solution, it can afford to have a slower layer 1, but layer 2 is actually quicker because it's a separate chain. So what are the implications of open finance? For the first time, there is the possibility to move liquidity from an analog world into a digital world with minimal reliance on existing FS infrastructure, example being banks. Liquidity can pool and aggregate in different ways, not constrained by physical commercial bank footprints and distribution networks, example, branches or ATMs. This erodes a long-term advantage that commercial banks have long held, a monopoly on cheap funding vis-a-vis deposits. By attempting to redefine financial services from the core, long-standing conventional wisdoms about how banking works will change. The result is the possibility for something fundamentally new to emerge. This is why open finance may turn out to be a more disruptive digitization narrative than we've seen in the past. And what they're basically saying here is that when you actually have a real store of value that is living digitally on the internet, this actually removes the need to deposit some sort of physical cash or asset at a bank in order to get that value into the system, because that value is already live on the system itself. So this is actually the part that goes into Ethereum's decentralized finance system. And the video that's popping up right now, you can check it out. I kind of go over this in detail if you want to learn more about it. So I'm going to skip over this part. The link for this article will be in the description if you want to check it out. Likely beneficiaries of open finance. The ultimate beneficiaries in the world of open finance will likely be consumers, and by extension, the financial services providers who choose to adapt to this new paradigm. However, the sustainability and degree of success for new business models will be predicated on continued maturity of two nascent open finance-enabled paradigms. Number one, level playing field and lowered barriers to entry for financial services. In a world with open finance, anybody with an internet connection can theoretically plug into an ecosystem of open financial services protocols. Example, which I talked about in the DeFi video, decentralized finance, built on public global settlement infrastructure. As long as this remains true, anyone can extend their business offerings to include financial services without much fixed cost investment, just OpEx to use the protocols. Number two, increase competition for liquidity, creating a profit motive for innovation. Most people don't realize that when they deposit cash at a bank, they are essentially investing their money with them. The fact that most banks pays a similar interest rate to its consumers suggests that the counterparty risk should be the same across all banks. This could not be farther from the truth. As we saw in the crisis, bank risk differs greatly depending on geographic footprint, product focus, underwriting competency. Most rational investors demand higher returns if they are exposed to higher risks. The only place where this does not hold true is in commercial bank deposits. If access to liquidity continues to be more democratized, new blockchain native offerings can compete on a more level playing field, passing along efficiencies to customers. Example below, which we'll get into. A world with increasingly digital liquidity creates a profit motive for innovation. Also, one thing that they don't really mention here is most of the interest rate that you get when you deposit money into like a savings account, the interest rate that you're getting on that doesn't even cover the inflation. It's a very, very low rate, and there really isn't a benefit for somebody to be investing their money in a bank anymore. And like they said, when you actually put money into a savings account, they are then immediately taking that money and loaning it out to people. I forget what the ratio is, but it's very high. It's something like, and I'm not sure if this is correct, but it's something like for every $30 that somebody deposited, they can loan out 20 or 25. It's probably even higher than that. So there's also stories where if you go and deposit, $500,000 into a bank, and then you want to immediately pull that money back out, they won't let you do it. So there's all these little things that go on in the banking system of now that really makes it so that if a competitor pops up that's truly a competitor like Open Finance or DeFi, they're really, it would be a no-brainer to go with this new system, since it would be better for the consumers and for the people that can't even get banking services because they don't, quote, meet the criteria for the bank. So this is the Open Finance lending example. So a traditional bank, the interest rate for the borrower, the interest rate paid to the saver, which is nothing. And FinTech lenders and Open Finance. Obviously, you guys can take a look at this. The link is in the description if you want to go into more detail. In the above hypothetical example, Open Finance offers the possibility to use shared infrastructure to dramatically lower technology and operation costs. Furthermore, the liquidity being digital, costs associated with physical distribution, bank branches, ATMs, etc., can also be lessened. This creates the possibility for modular financial services offerings to focus on high-value activities like underwriting, while passing along all cost savings to savers in the form of higher interest rates. And we actually saw this with some of the online banks, like I think Ally, that have no branches. And what they did was those are still classic banks, but those banks, because they had no branches or no physical buildings, they were basically able to turn that into a higher interest rate for their customers and savings for their customers. So this is like that on steroids, because in addition to there being no physical brick and mortar place where you have to go, there's technically no infrastructure as far as computers go, other than the cost to run on the Ethereum network, so to speak. So that would be gas and what other blockchain fees are involved with the transaction. Conclusion. In practice, trying to guess exactly which new players and business models emerge and when will be difficult. It is very possible for innovative business models to come from both incumbents, banks, wealth, and asset managers, through new startups and non-banks. The underlying drivers of change are the same. As both incumbents and startups become increasingly comfortable with the new paradigm, along with regulators and policymakers who begin to grasp the economic game theory associated with public blockchains, the conditions for open finance-inspired innovation will flourish. Reminding ourselves of the above quote, only by doing something different can one expect a different result. It will be exciting to see the new innovations, many of which we can't even imagine, built on this new world of open finance. And this is something that I've been saying since I first started making videos on this channel, is it will take time, but this is going to be the foundation of the new financial system for the world. It is more of an evolution than a revolution. It is quite a big quite a big change, but it is still using a lot of classic financial models that have been around for a while. It's just that we've distributed them in a way that allows for it to be cheaper for everybody, and also for there to be trust, which I believe we have lost since especially since the 2008, 2009 financial crisis. But I would argue it goes all the way back to 1913 with the Federal Reserve, and when Nixon took the U.S. off the gold standard in the 70s. So this is something that will actually challenge the financial industry that has been in place for a very long time. And as I said before, this is really something that is the first time in human history that we actually have something that will be truly fair to the consumer. So that's all I got for today, guys. Thanks. Have a good one.